Hello. In the last video, we covered the investment in fixed capital. We are now in week 2, video 2. We are going to devote some extended time to study the second part of the investment of companies, namely the investment in net working capital. We will do it by first understanding the concept itself in this video, then measuring it and analyzing it in video 3 before applying it to our video game company, Gremlin, in the video 4. What is net working capital? It is the difference, that's what we call it net, between the cyclical needs, the needs originated by the operating cycle of the company, and the cyclical resources, the resources provided by the operating cycle. Looks a little bit strange, but in other words, it is the net balance between the portion of my current assets and the portion of my current liabilities which are directly and exclusively associated with the operating cycle. What is this operating cycle? As shown on the slide, this is a sequence: purchasing, storage of raw material or spare parts, production, work in process, storage again of finished good, sales, and then collection of the money. When measured in dollars, we call it net working capital. But we can measure it also in days, as we are going to see in the third video. We call it cash conversion cycle. How long does it take between the time the cash goes out to pay the suppliers and the time the cash is coming back from the customers? It represents, in fact, the funds necessary to run the daily operations of a company. In fact, a company needs to finance raw materials purchase, goods that are in the process of being produced, or that have been produced, that is, inventories. It needs also to finance goods and services that have been produced and sold, but the proceeds of the sales have not been collected. Never forget something very important, that sales are a gift until collection of the money. These are accounts receivables. On the other hand, the company gets some raw materials or spare parts without paying them right away, which is reducing the amount invested in the operating cycle. These are accounts payable. The company can also benefit from other operating non-financial debts such as tax to be paid, custom duties to be paid, etc. These various items are called, by a strange name, accruals. Accruals means to be paid. And it is common to net them with some prepaid expense, prepaid tax in some cases, some insurance premium paid in advance, advance payment by customers, and this leads to net accruals. So to summarize all that, net working capital corresponds, as the slide is showing, to inventories plus accounts receivables minus accounts payable and net accruals. 5 main characteristics need to be remembered about the net working capital. First of all, the working capital is extremely sensitive to the type of business and is heavily impacted by cultural habits or practices. Some companies have no inventories, service business, some companies which are paid in cash and have no account receivable, supermarkets. In the tradition of payments by customers, there is a huge difference in delays of payment within the same continent. Look at Europe, the same continent. If you look at Southern Europe, Greece, Italy, Spain, Portugal, even France, we have something around 70 to 80 days of delay of payments by the customer. While in Northern Europe, Scandinavia, look at Finland, Denmark, Sweden, and Germany, we are more in the area of 30 days. If you are a fast-growing business, your working capital will grow very fast too. If your activity is stable, your net working capital has no reason to grow. And if you are in a declining business, net working capital should decline. But as we are going to see, it is not the case. And very often, it continues to grow, which is obviously leading to serious problems. The second characteristic of a net working capital is that it is liquid and permanent at the same time. How can we explain this paradox? It is liquid as it is made of liquid items, things that can be transformed into cash in a few days, in a few weeks, or in the worst cases, in a few months. But at the same time, it is permanent. It is constantly replaced and is therefore always here. Inventories sold are replaced by new inventories. Accounts receivable replaced by new accounts receivables. Third characteristic, net working capital is strongly impacted by seasonal factors. Think about the toy industry, which has to accumulate for months and months inventories to be ready for the end of the year sales. Think of a big part of the food and beverage industry. These seasonal factors have a very important consequence, which is that average numbers are often meaningless. And remember, by the way, that average numbers in management, in finance, are very often meaningless. Remember that one foot in the fire and one foot in the ice, on the average, pretty well, but it's painful on both sides. Four characteristics. Net working capital reflects the balance of bargaining power of the company vis-à-vis its suppliers and vis-à-vis its customers. Usually big groups have a very strong bargaining power vis-à-vis their suppliers and sometimes vis-à-vis their customers. Think about supermarkets, Walmart, Tesco, Carrefour. They are paid by the customers cash right away when they get out of the shop and have often 60, 90 days, sometimes more delay to pay their suppliers. Look, for example, at the evolution of the net working capital of a company in the US, Dell, between 1995 and 2010. Without going into detail of the table, you see that in 1995, the net working capital of Dell in days was something around 16 days. In 2010, they have reduced it and make it negative, minus 45 days. How did they do that? By speeding up the recovery, the collection of the receivables, by reducing tremendously the level of inventories, just in time and all that, and by increasing, doubling the time to pay the suppliers. The fifth and last characteristic of the working capital depends on also the accounting closing date. If you're a company making all its annual sales, let's say 100 million in December, and you are granting 30 days credit to your customers, your balance sheet will show on December 31st an accounts receivable of $100 million. Well, if you close your operation in March, your accounts receivable will be zero. This is, of course, an extreme case, an extreme example, but you should always ask yourself why a company is closing its account at a date different from December 31st. There are always good reasons. To conclude, let's look at the evolution of the net working capital of a typical company. You have first the fixed part of the net working capital, the one that you need even if your business is not growing. This is the horizontal line. Then we add the variable part, the one needed to grow your business. We all understand that if you double your sales with the same credit policy to your customers, your accounts receivables will double too. And finally, we add the seasonal part within each period, within each year, for example. Now that you understand better the concept of net working capital, the next question is, how do we calculate it? And how do we interpret and analyze it? This will be the topics of our third video of the week 2. So I'll see you very soon.